Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 28th of April. I'm Daniel Lam, your host for the podcast. During a client meeting yesterday, they were asking in awe about the speed of recovery in some of the risky assets from the start of the Middle East conflict in February 2026 to the recovery that we've seen over the last few weeks following the US-Iran ceasefire announcement. For example, the emerging market credit have rebounded sharply, despite still high uncertainties on the continuation of talks and Strait of Hormuz disruptions. The EMBI Global Diversified Index has reversed all of the spread widening seen since the start of the war. The market had been trading with limited differentiation between winners and losers from the energy supply shock. Technicals have been supportive and anchoring spreads to some extent, but there is going to be renewed supply pressure in the medium term. So therefore, valuations would diverge more clearly as economic data provides a clearer picture of the credit impact. Now, energy importers with weaker buffers are likely to bear the brunt, particularly if high oil prices persist during the ongoing supply disruptions. We see some analogy from the equities front, where there has been short squeeze and directional chasing for the technology stocks, but our preference is still in semiconductors and AI infrastructure stocks. The shortage of memory chip supply continues to be a key theme from the technology earnings announcement so far. We will get more clarity on CapEx demand when key hyperscalers report later this week. So, should we be fearful of the price action, or should we embrace it? Well, it is worth highlighting that the rebound in global equities seen so far this year, since the 2 months after the onset of the war, still lags the market performance observed during the 2 months after the onset of the Iraq War in 2003. And we've also seen sharp price recovery post-Liberation Day. As such, for equities, it has been a normalization of sentiment rather than overstretching valuations. Markets are behaving rationally by discounting strong earnings growth versus paying for excessive valuations. The bottom line is that stay invested. The discipline of such will help investors to get through the rough patches, such as March 2026, and they should be adding on pullbacks to the preferred areas, such as semiconductors, AI infrastructure, and EM bonds for countries with strong fundamentals. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.